Hi everyone! Wall Street closed last week with gains, however optimism will hardly last for long. A rebound looked like a respite after a sharp downward correction. The US unveiled loads of crucial economic reports. This and next week's traders will take notice of Jerome Powell's speech, the Nonfarm Payrolls report, the CPI and the Fed's key rate decision. This week, market participants are looking forward to Powell's testimony and NFP data. Comments of Fed officials on monetary policy usually stir up volatility. Traders are curious to hear Powell's remarks after the Atlanta Fed president's dovish ones. Stocks edged higher amidst his soft rhetoric. The Fed will also publish a summary of commentary on current economic conditions by Federal Reserve districts, the Beige Book. On Friday, traders will be particularly excited as the Nonfarm Payrolls report is on tap. The new figures are likely to impact trading sentiment at the start of next week and provide hints about the upcoming March meeting. Now everyone is asking the same questions. Will the Fed hike the rate more aggressively? Where is the restrictive level located now? When will the Fed stop the tightening cycle? Hence, volatility may increase given lots of market-driving events. Watch this video till the end and leave your comments down below. Let's start. Investors believe that the new non-farm payrolls will indicate that the labor market remains overheated. The economy is expected to add 215,000 jobs. The unemployment rate is likely to remain at 3.4%. Meanwhile, the average hourly wages could grow by 4.7% compared to the same period last year. A tight labor market and slowing inflation are bearish for stocks. The Fed is likely to stick to a hawkish stance for a longer period of time, given such a situation. Last week, inflation expectations rose to the highest level since last year, reaching 3.6%. Some analysts predict a possible acceleration of the CPI in the coming months. Such a scenario makes traders extremely nervous. It may affect risk appetite. Last week it was bolstered by China's upbeat economic data. China's outgoing Premier Li Keqiang announced at the opening session of the National People's Congress that the government intends to increase GDP by about 5% this year. He also unveiled new projections for 2023. The authorities do not plan to take new fiscal and monetary stimulus measures. The GDP growth target turned out to be lower than expected. It may indicate that global inflation will hardly surge after the opening of the Chinese economy. This week, investors will be preliminarily focused on the Fed's remarks and US macro stats. Stock markets started the new week without noticeable changes. The Dow Jones closed with a 40-pip increase, while S&P ended the week slightly above an important psychological level. The NASDAQ fell by 0.1% as government bond yields resumed growth, exerting pressure on stocks. Over the week, the Dow Jones rose by 1.8%. Its further trajectory will depend on Powell's speech. The Fed chair may provide clues about what to expect at the March meeting. However, the majority of speculators are betting on a 25 basis point rate hike. Nevertheless, Jerome Powell may point out that the central bank will have to raise rates more aggressively than anticipated at the last meeting. He may also suggest hiking rates above 5.1–5.4%. Currently, analysts reckon that the interest rate may approach 5.45%. Powell's comments could only confirm market expectations. Besides, now the Fed has no solid reason to raise rates more sharply. The regulator will continue to track incoming macroeconomic reports before making a rate decision. After the resignation of Lael Brainard, who was the main dove, Powell may also switch to a tougher stance. This scenario looks likely given the strong economic data and risks of high inflation. The S&P 500 notched a great result last week. It climbed above 4,000. The closing of the week near this level and a weekly increase of 1.9% signal a further upward movement. However, its movements will also depend on Powell's speech and the market reaction to NFP data. Last week, the stock market advanced following the statement of Atlanta Fed President Raphael Bostic. He mentioned the likelihood of a possible pause in the tightening cycle by the middle or end of summer. However, he would also hint at a 25 basis point rate increase in March, May, June, and possibly in July before a policy reversal. The rally was triggered by algorithmic systems that reacted to the keywords in his statements. The S&P chart shows bullish positioning. However, bulls will soon face a strong resistance area of 4,050, 4,080. The S&P could rise to 4,080. After that, it will be more difficult to move higher because of the key events of the coming weeks. However, some investors are still sure that the index has reached the bottom at 3,980 and should climb higher. The pullback below this level was a temporary weakness. To cement an upward movement, the index needs to consolidate above 4,080 in order to return to 4,190 and then to 4,200. A stronger resistance level is located at 4,320. Bulls will hardly be able to push the index above this level given the lack of new drivers, yet they may appear later. A drop below 3,880 will indicate a false bullish breakout. In this case, the price may fall sharply to the support level of 3,760. The heavy tech NASDAQ logged the best weekly performance, adding 2.6%. This is rather difficult not to lose this gain. Despite last week's growth, all three benchmark indices are unable to advance as traders are again revising the monetary policy prospects. Investors are again at a crossroads. The same situation occurred a month ago. However, since then, everything has been more or less clear until recently. Futures on the NASDAQ dipped below a month low of 11,800. Thus, bulls lost half of the growth from the lows of early January to the February highs. As of Monday, March 7, its trajectory is rather mixed. Traders seem to be waiting for signals to either push it up or down. The January rally began from 10,700 to 12,700. This means that the market dynamics of today and tomorrow may become decisive for the index, especially for its short-term trend. If it settles below the pivot level, it will signal a further rollback. In this case, robust growth at the start of the year was just an upward correction. Investors will be extremely puzzled if the NASDAQ declines to 10,700. However, the situation may change. There is a chance of a sharp rise in the first half of March. If this assumption is correct, it will be a bullish signal for traders. At the start of the week, Apple shares were in the limelight. They jumped by more than 2% on Monday after Goldman Sachs rated Apple stock a buy for the first time in nearly 6 years. Tesla shares lost 5.2% last week after Elon Musk revealed Tesla's third master plan at the company's Investor Day event. Musk also announced a new model of an electric car which would be cheaper than the previous one. However, he did not specify the date and the approximate cost of the future model. Tesla shares remain popular among investors. In February, they hit their biggest trading volumes among other American stocks. That is all for now. Hit the subscribe button and stay up to date with the latest market news. See you!